And welcome back, options traders. Well, a question that I hear from a lot of people or comments is about planning an exit strategy before you even enter the trade. It's a common tactic among traders, and I've even heard people make analogies to the police or to the fire department, and they might say, for instance, before firemen enter a burning building, that they already know their exits. They have their exit strategies already planned before they even go in. And so the more they talk about it, new traders say, well, that makes a lot of sense, and therefore it applies to the stock market. As soon as we enter the trade, we should know where we're going to get out. Well, it might make sense, but does it really? Should you plan an exit strategy before the trade? Well, that's what we're going to talk about today. And as always, before we do, please be sure to click like and subscribe. It's definitely very much appreciated and helps to promote the channel. So let's talk a little bit about an exit strategy. What is it? Well, it's really just a checklist that outlines when to close a trade. You could say it could be based on price. When the price of the underlying reaches a certain level, that you're going to get out. Or the price of the actual option, let's say, that you're trading, when its price hits a certain level. Or it could be a certain percentage. When I've lost 20%, I want to get out. It could also be based on technical levels. So if the stock price crosses the 50-day moving average or the 100-day moving average, or if the RSI turns below a certain level, we're going to exit. And once again, traders often do this before placing the trade. And they do it because it seems to make a lot of sense. But the problem is, unlike with the fire department, it requires you to have a crystal ball. So the analogy doesn't really hold for the stock market. For a fireman entering a burning building, sure, it's just that one building. It's always going to be the same. That's what you have to work with. And you can certainly place exit strategies before entering. But the stock market changes. Every single moment of the day, you are subjected to new information, new stock prices, and it's always changing. And so if you are going to set your exit strategy based on today's prices, you're guessing. You're guessing that if the stock falls from, let's say, 100 to 98, that's going to be the optimal time to exit. So the first problem, and probably the biggest, is that the chance for you to pick the highest point to exit is nearly zero. So again, if you buy shares at 100 and let's say you're going to exit if it hits 98, well, that would be a great strategy if the stock never sees 98 again. In other words, you picked the highest point to exit. And the chances of you doing that are nearly zero. But the reason that it sounds like a good idea is that traders assume that the momentum will continue in the wrong direction. So you buy the stock at 100, it drifts down to 98, and they say, oh, it's now falling. So again, for instance, let's say that you buy stock at 100 and you arbitrarily pick the price of 98. So if the stock price hits 98, I'm going to exit. Or maybe you set a stop and you say, that's where I want to get out. Well, who's to say that that's going to be the highest point? How do you know that the stock's not going to be 99 or 105 or 120 in the future? Who's to say that this slight downward momentum is going to continue? And it doesn't really matter what stock price you pick. If you say, I'm going to pick 95 or a 5% loss, and that's where I want to exit. Sounds like a great idea, but you need a crystal ball to make that decision. So one of the ways to see why this isn't a good idea is to remember that for any stock price, you always have an implied bell curve sitting right over that stock price. So let's say that here's our current stock price, let's just make it 100, and the stock falls maybe to 95. Well, now we have a new bell curve, and of course it's not quite as tall because some time has gone by, but it's still a bell curve over the current stock price. See, if you just started trading on this day and you said, oh, the stock is at 95, you're coming in with a clean slate, you're saying the stock could equally rise or fall, it's trading at 95, there's the center of our bell curve. But if you bought it at 100, it's actually a problem that's related to anchoring, kind of a behavioral finance problem where it's more about the psychology. And you tend to think that that's really the true value and that Now that it's trading at 95, it's got this downward momentum. But again, a new trader coming in would say, oh no, this is the fair value at 95. It's equally likely to go up or down. So notice with this red line, let's say that this is 95, half of these stock prices are likely to fall to the left or lower, but you're also going to see about half of them roll over to this side. And notice that there's a pretty good area that's even above the stock price where you purchased. So that's the whole problem, is that people just assume that just because the stock has moved down to, let's say, 95, that for some reason it just must keep going. That's just fear talking. People just hate to lose money. It's risk aversion. So once they see that, they want to exit. So why does this strategy often backfire? Well, first, the trade that you close may actually rebound, which is what I just showed. And to add insult to injury, the new trade might collapse. Who's to say that just because you exited one, that's the bad trade and the one that you got into is the good trade? Switching isn't managing the risk. Now, sometimes people say, yeah, but I can see that first trade is now heading down. It's got downward momentum and this new one's heading up. Well, if that were true, if your intuition gave you an edge, you wouldn't be in this predicament in the first place. You wouldn't have let the first trade go against you. So if you think that switching is giving you an edge, then that's just an illusion. But what makes it even worse is when you arbitrarily pick a point before you've even gotten into the trade. So to see this a little bit more visually, let's jump over to an Excel spreadsheet and take a look at some random stock prices. All right, so now we're into an Excel spreadsheet, and what I've done is I've given a hypothetical stock about 252 trading days, which is roughly the number of trading days in a year, and I'm going to give it volatility of 20%. Now I've set up this sheet to where we can change that number. We're going to start our stock price at 100, and then we're going to pick an arbitrary exit point, right now at 95, and again we could change that, but for this video I'm just going to leave it at 95. And what Excel is doing is it's flipping a coin, and if we get heads, we are going to increase the stock's price according to this volatility, which if you've seen some of the previous video, you know that if we have 20% annualized volatility, you know that the daily volatility will be roughly the square root of 256, roughly the trading days in a year, which gives us a nice round number of 16. So if we take 20% divided by 16, we get 1.25%. So our stock price is either going to increase by 1.25% if we flip heads or a 1, or it's going to subtract 1.25% from the previous day if we land tails. So here's the first sequence. This is the stock price starting at 100, traveling throughout the year. This is the final price at the end of the year. And this is our arbitrary exit point in red at 95. Let's say that right here we get triggered out. Now, of course, down here, we're going to feel really good about ourselves and say, oh, it was a really good idea to set that stop. But look what happened. It wasn't the high point. We could have gotten out at much higher prices. This is now the right side of that second bell curve that we saw in the presentation. And what I'm going to show you here is that this is what's going to happen most of the time. Only very few times are you going to continue out into that far left tail. So let's go try another one. Okay, so here's another one. We buy at 100, we get triggered out here, feeling pretty good, and then, would have been much better off out here, and certainly much better off out here, and far better off out here. This is, again, the right side of that bell curve over time. Here's another one. We buy at 100, we get triggered out right there, feeling pretty good since the stock price is drifting lower, but then we would have been much better off if we had continued to hold. Here's one where we never triggered at all. Here's another. Here's another where we would have gotten triggered out down here, only felt good for a very short time, and then after this, big regrets. Now here's one where it might have worked at least okay. We get triggered out here. We might have been able to get out at about the same price. We avoided these lows, might have been able to get out at around 100, but that didn't really work out too poorly. Here's another where we never got triggered. Here's another where it backfired. So again, the only thing I'm looking at is once we get triggered out on the red line, is that the highest price going forward? No, we would have been better off out here, much better off out here. Here's another good example. We get tripped out right here. Lots of volatility in this path. Would have been better off out here or here, out here, much better off out here. We would have been better off not picking an arbitrary point. Okay, now here's one where it would have helped. We get triggered out here and we never saw another high point. At no point was this blue line back up to that red. So this is one where it did help, but notice how rare these occur. That's because we're continuing to drift left onto that bell curve. And each time we get a new bell curve out to the left, you're just going further and further out into that left tail, meaning that it's less and less likely to continue in that direction. All right, let's just try another one. And there we go. Buy at 100, get tripped out right there, feeling pretty good about ourselves, and then we find out regrets, big regrets up here, and even bigger regrets out here. So what I'm trying to show is that yes, there will be some times that you just get lucky and the point that you get triggered out is the highest point going forward, at least for some time into the future. But in most of the cases, that's not going to be the outcome. And it makes it even worse when you're just picking arbitrary points before you've even placed the trade. So what's the better strategy? Well, as always, trade what the market gives, not what you want. You have to trade the prices that the market provides in the current conditions, and you don't know those ahead of time. Wait for things to unfold, wait for the cards to be dealt, and then you can make better decisions about your hedges, rolls, and morphs. So make decisions as market prices change, not beforehand. Also, equally important, if your initial thesis, the reason that you got into the trade, is intact, continue holding. If you thought this $100 stock was going to go to 120 over the course of a year, and it's down to 95 after a couple of weeks, nothing said that you're wrong. Nothing has come out in the news that says that you're wrong. That's just a random walk. Continue to hold. But most important, use options to manage the risk that you're not willing to assume, and probably more important, make sure that your strategies aren't interfering with the risks that you do wish to take. And for anyone who'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.